Hi, and welcome back to the LLQP video series. Again, this is Jason Watt from Business Career College. What we're going to talk about today is creditor protection. This topic around creditor protection has a fair bit of overlap into several different modules in the course. We deal with this to some extent in Module 3, and it also overlaps into Module 8. And we'll even touch a little bit on modules 12 and 14. So what creditor protection refers to, why does it matter, or when is it applicable? Well, this can be important for somebody who finds themselves subject to a lawsuit, so if you're sued, that is, or this can also be relevant if you have to declare bankruptcy. That is, if you are in a position where you're not able to support your own debts, you may have to declare bankruptcy. And it can be useful in these situations. Both of these scenarios are going to have various parties looking to attach themselves to your assets, that is, to create a claim against your assets. So it can be useful here to have some funds that would be protected from the claims of creditors. Now, in virtually all cases, if you knowingly hide funds where you're fairly certain or it's obvious that you're going to be doing one of these things, then your creditor protection doesn't apply. So generally, when we look at creditor protection, we're only looking at it in a big picture sense. But if I know I'm getting sued and I hide a bunch of money, I'm going to lose that creditor protection. So when would I have creditor protection? Well, if I get sued, so this is during my lifetime now, and I find myself subject to a lawsuit. If I have a life insurance policy with a cash value, so a cash surrender value or account value for a life insurance policy, as would be the case with a universal life or a whole life policy, or the actual market value of a segregated fund or an IVIC, then I may have creditor protection. I will have creditor protection only if I have named the proper beneficiary. So if my beneficiary is my excuse me, if my beneficiary is my parent, my spouse, my child, or my grandchild. So if any of those apply, then I have creditor protection during my lifetime. I can also get creditor protection if I name an irrevocable beneficiary. That is, I could name anybody as beneficiary, and if I make them irrevocable, then I will still have that same creditor protection as if I had named a parent, spouse, child, or grandchild. Now, that does not apply in any scenario to your estate. So you never have creditor protection if your estate is beneficiary. You can't make your estate an irrevocable beneficiary. That's really like naming yourself as beneficiary. So you have to have another party, either one of those four, parent, spouse, child, or grandchild, or the estate named as beneficiary. Now that's if you are alive and you get sued, or you have to declare bankruptcy, those amounts would be protected. As long as they've been invested for more than a year. So you have to have those invested for more than 1 year. Or there have been cases where the courts have been able to poke holes in creditor protection, even on investments made up to 5 years, where the person was hiding money, where they knew they were going to get sued and they were hiding money anyway. So it's up to 5 years if your activity is suspicious, if it seems like you're trying to hide money. Okay? And usually those cases are pretty obvious. It's not innocent people that tend to get caught up in that. Now, there's another set of creditor protection that we're concerned with, and that's what arises on death. So on death, your death benefit is also creditor protected. And this is in the case of any named beneficiary, that is, any beneficiary except your own estate. So the result here is that funds flow directly to that beneficiary regardless of the claims of creditors of the deceased. That is, if I die owing money and I have named any beneficiary at all other than my estate, the funds would flow to that beneficiary and my creditor could not touch that money. Now, you have to be a little bit careful around corporate-owned insurance. Where you have corporate-owned insurance, it's very common for the corporation to be both the beneficiary and the policy owner. In that case, you're not going to have creditor protection, and scenarios where you have ownership and beneficiary designations split out with corporate-owned insurance are relatively rare. So these are the basics where we get creditor protection. Now to contrast this with non-life insurance products, you don't have this creditor protection with your bank accounts or mutual funds or with real estate or whatever the case is. Generally, other property is subject to the claims of creditors. There are some exceptions to that. If you have a pension, for example, your pension is generally not subject to the claims of your creditors. Other examples would be RRSPs. The RRSP, the Registered Retirement Savings Plan, it doesn't have the full range of creditor protection afforded life insurance, but it does have creditor protection in the event of bankruptcy. This does vary a little bit from province to province. The rules around bankruptcy protection vary, but essentially in every province you're going to have, at the very least with your RRSP, bankruptcy protection, meaning if you have to take the fairly extreme step of declaring bankruptcy, your RRSPs are not subject to forfeiture to your creditors. Now, we can see then that we have varying degrees of creditor protection with other sorts of property, but with our life insurance or our seg funds, we have 1 degree of creditor protection if you're sued during your lifetime. That is, if you've named the proper beneficiary, then you have creditor protection. So this is during your lifetime. And then on death, you have a different degree of creditor protection, and that applies if you've named a separate named beneficiary. I hope that helps to understand the topic of creditor protection. It's a topic that has far-reaching consequences. One last thing that I should mention is that none of this applies in the event of divorce. In the event of divorce, all your property is subject to whatever matrimonial property rules apply in the province that you're in. It doesn't matter if it's life insurance or RRSPs or whatever the case is. All of this stuff would go into the mix in the event of a division of matrimonial property on divorce. That's not an examinable topic, but I thought it might be something that people would be interested in. So again, I hope that helps with creditor protection. Enjoy the rest of your studies. Thank you.